everybody, and welcome to the Interactive Broker Sense of Security podcast. Today, we're talking to Jose Torres, IB Senior Economist. Hi, Jose. How are you?
Hi, Mary. Doing great. Excited to be here once again in the Sense of Security weekly series.
So, tell us what happened in this inflation report today.
The inflation report, I wrote on October 23rd that I thought that the bar was far too high at 3.1% for both the overall consumer price index as well as the core segment. Both were expected to come in at 3.1%. They actually came in at 3%. Because it came in below expectations and there's limited evidence that tariffs are igniting significant cost pressures. Wall Street is rallying, bond yields are falling, and stocks have reached fresh all-time highs. Pretty much the October and December Federal Reserve meetings, those are in the bag as far as 25 basis point cuts are concerned. However, the number of rate cuts in 2026, that's becoming more top of mind for market participants right now. We're expecting roughly 3 rate cuts in 2026.
So, why is core inflation considered more meaningful than headline inflation?
Headline inflation could be significantly altered sometimes by the volatile food and energy categories, because sometimes due to surpluses or shortages of the particular materials, you could have surges in energy prices and food prices or significant declines that aren't necessarily representative of the inflation picture. But core excludes those two volatile categories, and it's a better gauge of medium to long-term price pressure implications and the trajectory of inflation over the medium to long term. So that's why the 2% target is overall inflation, but sometimes a spike in oil, for example, could make it seem as if we're way above the Fed's target, when in reality, as soon as those prices come back in, inflation will be more or less better behaved and closer perhaps to the Fed's target, depending on the context, of course.
So, it sounds like these structural factors, especially tariffs, they are driving the shift into a higher inflation regime, although everybody's happily surprised that tariffs aren't affecting it too much.
Yeah, that's been the theme since the beginning of the year. I've been telling folks not to worry too much about tariffs. We have the example from Trump 1.0, when you had tariffs implemented on the world's second biggest economy, China, and you didn't really see much inflation. In fact, similar to this cycle, hopefully you saw inflation top out at around 2.9%, 3%, only for it to begin to submerge back to the 2% area. Tariffs really concern core goods, and that comprises roughly 20% of the CPI. I've been telling folks, you can have an increase in core goods as long as the other areas aren't too inflationary. You're not going to have too much of a problem. And we saw that today. We saw household furniture increase in price. We saw apparel post the sharpest increase in a year. We saw recreational goods pick up. But Mary, they really didn't move the needle much, because housing, shelter, that is, which includes owner's equivalent rents as well as hotel stays, it comprises roughly 45% of the CPI.
Yeah.
Most of household budgets, they are allocated to housing, to shelter, and that's really what the weightings of the consumer price index are designed to reflect, is what share of household budgets are folks spending on shelter, food, transportation, medical care, etc. So you got this big deceleration in housing costs. August, you saw 0.4% growth rate. September, you're down to 0.2. And that's really why you had this big miss on CPI. The monthly and annualized figures for overall and core, they all missed by 0.1%. So all the 4 important numbers. So for example, overall was expected to come in at 0.4, 0.3. The annualized 3.1 came in at 3%. For the core segment, expected to be up 0.3%, up 0.2. Similarly, annualized, expected 3.1, 3%. You had some deflation too. Used cars, that's a big tariff sensitive area. Used car prices went down. New automobiles, those costs also, they didn't go down, but they decelerated. Energy services, that's heating and electricity, that also offered some deflationary force. It was the 0.7% month over month decline in energy services, natural gas related, that's electricity and heating. That helped bring the number down. Gasoline, however, was the top riser. It rose 4.1% month over month. And that's another reason actually to be optimistic, because gasoline prices recently have been cooperating. So what does that mean for October, November, and December inflation reports? We have this favorable effect from energy, and gasoline costs are going to come down. So that actually pushed inflation higher in September. That's going to move into a deflationary stance in October based on our real-time indicators here. So that's something to be very excited about if you're a treasury bull or a stock market bull, because you're going to get better inflation figures. And then also the base effect. So October, November, and December last year, you're coming off of some high numbers. So because of those high comps last year, that makes it a little easier to get some lighter numbers on an annualized basis going forward in October, November, and December. The theme really remains consistent. From the beginning of the year, we're looking for a re-accelerating economy. It's what we're seeing. We also got the flash PMIs report this morning for the US and for international areas as well, so like the EU, Japan, and UK. And it was October is the second strongest month for economic growth all year so far. So we're seeing a re-accelerating economy. That's part of the reason why inflation's at 3%, because businesses have pricing power. The servicers, there's a lot of demand. Folks are out there spending. The lower and the middle income cohorts, they're really supported by a low unemployment rate. And the high income cohorts, they're supported by the buoyant capital markets, stocks, crypto, treasuries, gold. We really have this significant rally in markets, and that's really supporting consumption all across the board.
So it was important to get this report out also because we're having a shutdown right now because of Social Security. Can you tell us about that?
Absolutely. Social Security, they have statutory deadlines as to when they need to publish the annualized increase, the COLA, the cost of living adjustment. After today's CPI report, it's 2.8% for 2026. Roughly 75 million Americans receive Social Security checks. So, of course, that is a significant impact. So due to the special circumstances, the BLS decided to bring back some people just to prepare the CPI so that those numbers could be available to the Social Security Administration so that they can set the correct amounts and then deliver those payments in a timely manner.
It seems that gas was up and electricity was down. Is that true?
Yeah, gasoline is heavily influenced by crude oil, whereas electricity and heating, they're much more influenced by natural gas trends. So oftentimes those two commodities, they move in different directions. And we saw it in September where gasoline was a tailwind for inflation, but electricity and heating offered deflationary wins.
So, Jose, what else do we have coming up this week?
We have a big meeting between President Trump and Xi Jinping of China. That's going to definitely affect investor sentiment as far as relations between Beijing and Washington are concerned. Those are the two top economies in the world. There's an expectation, however, that there's going to be some progress reported, but you really have long-standing issues between the two nations, and it's going to be more of an extended standoff, albeit within that long episode, you're going to have some areas, some time spans where there will be cooperation, but that can become tension after a few months or so, because China's goal is to be the number one economy in the world. And to be the number one economy in the world, then essentially that's naturally going to conflict with the US's goals. For that reason, there's an expectation that the tension between the two nations will remain at least at a neutral level for the foreseeable future.
Okay, Jose, that was excellent. Thank you so much for your insight, as always.
My pleasure, Mary. Looking forward to seeing you next weekend. Bye, everyone.
Bye.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC Risk Disclosure. A copy and additional information are available at ibkr.com. Trading in digital assets, including cryptocurrencies, is especially risky and is only for individuals with a high risk tolerance and the financial ability to sustain losses. Eligibility to trade in digital asset products may vary based on jurisdiction.
U.S. spot gold trading through IB LLC accounts is only available to legal residents of the United States that do not reside in Arizona, Montana, New Hampshire, and Rhode Island.